All right, scholars, we're now ready to pick up with the acquisition method. How do we do a consolidation of two companies in making them one financial statement? Even though they're legally two separate entities and they have two separate sets of books, we're going to combine everything together. So the acquisition method is taking those two legally separate entities, but controlled by one, and we're going to combine them. Now, it has two distinct characteristics. We're going to show all of the balance sheet accounts, assets and liabilities at 100% of their fair value on the date of acquisition. Even if we don't buy 100%, if we buy 60 and therefore we don't own 40%, that 40%, that total value will be shown. So we'll show the total value and then we'll put this credit saying, oh, this is the amount we don't own. So it's the total value minus the non-controlling interest, the percentage we don't own. So that's going to be the first item. And then the sub's equity is completely eliminated. We're going to say we have an investment in their equity. We're going to get rid of our investment account against their equity and then combine everything. But here's the problem. The amount we pay will be the fair value. Their equity section might be an old historical cost. So we're paying today's fair value, and yet, in this case, the old historical equity, they don't agree. So there's going to be a reconciliation, and we're going to show you how to do that. So what we're going to state here is the fair value is generally presumed to be the acquisition price. So therefore, the price you paid is going to be your investment in sub. Now, the journal entry, which we're going to introduce to you a little bit later in greater detail, is the car I'm in is big. It's a really simple way of going through a checklist of the items. The car is the common stock of the sub, the additional paid-in capital of the sub, and the retained earnings of the sub. By debiting all three of them, we're eliminating them. What are we eliminating them against? The investment in the sub. That was our asset, right? We debited investment and credited the cash we paid. Well, now we're going to get rid of the investment. So to get rid of the investment, we'll credit it. So it's the old owner's historical costs. Those are being debited to get rid of them. And then our asset at fair value is being eliminated with a credit. But they're not going to agree. Old cost versus today's fair value, the price we paid. Well, maybe we didn't buy the whole thing. And if there isn't the purchase of 100%, we'll create a non-controlling interest for whatever we don't own. But we still have the reconciliation, and that's a big deal. The balance sheet of the sub, all of the accounts will be adjusted to their fair value. Maybe inventory will be written up. Maybe property, plant, and equipment will be written up. Maybe there'll be in-process R&D that we have to do, etc. So we'll create those. We'll have intangible assets that they didn't even have on their books that we'll say, wait a minute, they've got that. So we'll book those. And then if there's still a difference, any unexplained difference is a plug to the goodwill account. So the car is their historical cost, getting rid of it. We're getting rid of our investment account. There's the credit. One is at historical cost, one's at fair value. The non-controlling interest is for any portion we don't own. And then big, B-I-G, is all of the adjustments to reconcile historical costs to the fair value we paid. So let's take a look. We're going to start with the car, the common stock, additional paid-in capital, and retained earnings of the subsidiary. They're eliminated by debiting them. Notice the pre-acquisition equity is not carried forward on the consolidated financials. It is on their records, but when we take their records and we take our records and we put it on a spreadsheet, we'll eliminate it for consolidation purposes. You'll notice right here, the consolidated equity is going to be only the parent's equity plus any non-controlling interest, the portion we don't own. So it's all of our company plus the portion of their company we own plus the portion we don't own. And then the subsidiary's equity is eliminated, as we said, by debiting it. So let's think about this for a moment. You've got a formula that you've known for years. Assets minus liabilities equals equity, right? Equity is the common stock, APIC, and retained earnings. You also know it as assets minus liabilities equals net book value. Well, now we're just adding a new term, Assets minus liabilities equals CAR. So we will show assets at full value, liabilities at full value, CAR is eliminated. That's the fundamentals of the first portion of this journal entry. Then the investment in sub, which remember was our purchase price at the fair value on the date of commencement here. That will also be eliminated. So the parent's investment in sub, which was at fair value, the price we paid, is going to be eliminated, and that will be eliminated with a credit. Then, of course, if we didn't own 100% of the company, we have to show that there's a portion that somebody else owns. We call that the non-controlling interest. We create the non-controlling interest for the percentage of the subsidiary that we do not own. And that will appear in the equity section of the consolidated financials. As I said a little bit earlier, you'll have the parent's equity, and then you'll have the non-controlling interest, the portion of the sub we don't own. Then you have the big. These are the accounts that reconcile the old owner's historical cost to the price we paid. Remember, we're going to book all of the assets at 100% fair value, all the liabilities at 100% fair value. So all the subs balance sheet accounts, assets and liabilities, are adjusted to their 100% fair value on the date of acquisition. Now, this is accomplished through what we call an eliminating journal entry. I don't personally like that. I've never liked that term. I would prefer to call it your consolidating journal entry because, yes, you are eliminating the common stock, additional paid-in capital, and retained earnings of the subsidiary by debiting it. Okay, so far it's a good term, eliminating journal entry. You are eliminating the actual investment in sub with a credit. Okay, so far it's still a good term, eliminating journal entry. But then you're creating the non-controlling interest. Then you're going to be adjusting the balance sheet. We're going to be creating intangibles, and then we're going to be plugging goodwill. So I like the term consolidating. I think that's a little bit broader a term of what's actually accomplished right here. So once again, this adjustment is done regardless of the amount paid. Everything is booked to the fair value. And remember, it's 100% of the fair value, even if you didn't buy 100% of the company. We then look at the I, which is in big BI, we create intangibles. Another reason why I like consolidating journal entry. We create this for the premium we paid. You may have some in-process R&D. Well, you paid, so you get to capitalize that. You may have paid for a covenant not to compete. The old owners promised not to start a new business and go into direct competition against you, right? There may be some patents that were worth a lot of money, so you're going to book those. You may have some other items that are finite-lived intangibles, and you're going to book those. You will book those at their fair value. This is done even if the amount was not incurred to acquire these items. You're going to record them. And then finally, the G of big, B-I-G, is goodwill. It's essentially the excess of the price you paid versus everything else you could allocate it to at fair value. And you still got some of this value left over. I like to refer to it as the plug. Yes, if you get a real PhD academic, they're going to say, well, it's actually the excess potential earnings of the company over normalized earnings discounted at a reasonable rate of return for an exit. You know what? In the real world, I've dealt with these over 40 years. And ultimately, when I say, how did that goodwill number come up? And they said, it was the amount we paid that we had to negotiate, and we can't figure out where to allocate it else. It's the plug. Now, one item, what happens if you got a bargain? Somebody was so anxious to get out that they gave it to you at a huge bargain, less than the value of everything. Then in theory, you may actually have a difference. So you may have, in that case, the deficiency, the acquisition cost compared to the fair value. Then that shortage, the negative amount, is recorded as a gain. Hey, I got more than I had to pay for. So you recognize a gain at that point. By the way, that still stays in the G, doesn't it? Big, B-I-G. So if it's a positive, you paid extra, goodwill. If you got it at a bargain, you call it a gain. So here's the journal entry once again. And I like to call it, as I said, the consolidating journal entry. We're eliminating the subs equity, common stock, additional paid-in capital, and retained earnings. We're offsetting that against our fair value just paid, the investment in sub. Old owners' historical cost, our fair value paid, aren't going to agree. So it may be that there's a non-controlling interest for some of the items, but the balance sheet will be adjusted to fair value, all items 100%. Intangibles will be recorded 100% of their value, and then a plug for any unexplained difference goes to goodwill. So there is your fundamentals of how to do this journal entry. And if you want to, you can kind of look at it as a sliding scale. It's debits and credits, but you're going to start with getting rid of the car against your investment account. And if that balance is great, you're done. That's the easiest of all. That means you paid exactly what book value is, and book value is exactly what fair value is. Probably not going to happen on the CPA exam. Now, if there happens to be a non-controlling interest, you would factor that in right away. But let's pretend there isn't. So your investment doesn't equal the car. The car is the old owner's historical cost. You have the investment account that you paid at fair value. Well, you got to reconcile it. First thing, look at their balance sheet and adjust all the items to their fair value. Their building has gone up in value. Their inventory may have gone up in value. Well, anything else? Oh, wait a second. They had intangibles. Book those and add those in. Oh, wait a minute. There's still some extra left over. Plug it to goodwill. So essentially, it's kind of balancing out the debits and the credits. So as we said, you have your car. You have your car as the equity of the sub getting eliminated. Again, we have our investment account and the non-controlling interest. If that works out, you're in great shape. But of course, there's going to be some differences. Balance sheet will be adjusted to 100% fair value, even though you don't own 100%. Remember, the portion you didn't own was then credited to the non-controlling, the other owners. If there's still a difference, then you look at the intangibles. And then if there's still a difference, if you need a debit because you paid more, goodwill. If you need a credit because you paid less, you got a bargain, you call it a gain. So once again, another way to look at this is you look at the book value of the sub, you compare it to the fair value, and any difference there is recorded to the fair value of all the assets and the creation of the intangibles. Then you look at that, all of those assets compared to whatever price you did pay, and any extra price is the plug to the goodwill account. So you can see there's 1,000 ways you can look at this, but they all arrive at the exact same solution. Balance sheet adjustment first, intangibles next, plug goodwill, final solution. And hopefully with that fundamentals, you're going to start seeing that when we work a big problem a little bit later on in one of the other testlets, you're going to see that it really starts to make sense. But at this point, we're ready to move on to our next area.